Hello everyone, welcome to the 158th episode of me learning how to trade in Forex. So in the last episode we went through the impact of time. Basically, time is one of the biggest considerations when making trading or investment decisions. It can also influence your risk profile, which we discussed in some other lesson. Right? So to work out which products could help you achieve your financial goals, think about when you're implementing strategy and when you need to close it out. And then we went through what is something called a time horizon, basically how long you plan to hold your positions for. And this would vary from investors. You might have multiple strategies running simultaneously with multiple different time horizons. Okay, and then we went through different investment time horizons. So investment time horizons is split into three different chunks, I guess, categories: long, medium, and short term. So long-term horizons can expect to hold investments for 10 to 20 years or even longer, right? So these are things like retirement savings, as there's something you want to build well in advance. And then we got medium term, is basically 3 to 10 years. So this might be if you're saving up for your, I don't know, like, or the example they gave here was child's college fund, so something like that. And then to do this, you could, did I say what it would do for, retirement savings. So to do this, you could do bonds and stocks to benefit from the potential coupons or dividends. And then short-term time horizons are usually less than 3 years. So this is where you're preparing to buy a house or need to use a fund soon for something else, like a car or something like that. Right? So then, this case, invest in short-term products like bonds, short-term bonds, so you have quicker access to your money. Okay, and then we've got the trading time horizons. So same thing as investment time horizons, long, medium, and short. So if you're short-term, you could make use of leverage derivatives to amplify your potential gains. But remember, as always, when using leverage, double-edged sword, so you can have a positive, increase positive, but you can also increase your negative losses. Right? And then you need to account for the cost of trading. So overnight funding fees may seem small, like a day or two, but given time over a long period, they'll add up. So these costs are unnecessary costs which could eat into your profits. So you need to understand how you'll be charged with the overnight funding fees. Trading style will also influence your time horizon. So if you're a day trader or a scalper, you probably won't hold your positions any longer than the end of the trading day. So trades are usually opened and closed in a matter of seconds or minutes within the day. And then we've got the swing, momentum, and position traders can stay in the market for days, weeks, or even months. So in this case, you have longer term trading horizons. And we've got the link between time and risk. So if your time horizon is a distant future, you're further away from your liquidity. This means that there could be more opportunity cost and more time for the markets to move against you. Right, so how long you plan to hold a position can also determine how much risk you can accept. So I guess the longer your time horizon, the more risk you could take on, maybe, because you're giving the market some time to recover. And then we've got ultimately how much risk you take on is up to you. So you can stick to products that seem more secure or use a range of different ones to meet your various financial needs. So mixture of high risk and low risk and medium risk investments. And yeah, so if investing for the long term, you have a time horizon that spans for a long time. So that could you could check your portfolio less often because of that. But if you got a short time frame, then you probably need to check your portfolio very often because price movements can occur in seconds and your open positions could experience significant losses. Right, and then we went through a lesson summary. We also went through finding the right products, but we stopped at the exchange traded funds. So we went through the investment products, and the managed portfolios. So now on to exchange traded funds. So let's carry on off where we left off last lesson. I don't know if that makes any sense, but yeah. So exchange traded funds, or ETF for short. Collection of very nice diagrams, you know. Do this, bam, bam. What's this? This is investment products. So do that. Then we've got managed portfolios. And then exchange traded funds. So boom, boom. Okay, so exchange traded funds track a collection of shares such as index or even different assets like stock and bonds. They're a relatively simple way to get exposure to a range of shares. So ETFs track a collection of shares such as an index or even different assets such as stocks and bonds. They're a relatively simple way to get exposure to a range of assets. So they're a relatively simple way to get exposure to a range of shares. You buy them as you would a share in your share trading. You buy them as you would a share in your share dealing account, and they may also be included in some managed portfolios. So you buy them as you would a share in a share dealing account. They may also be included in some managed portfolios. Diverse and low cost, they're another path you could choose when starting your investment journey. ETFs are diverse and low cost. They are a time saver as you don't need to research individual shares. Instead, you can select an ETF with a theme, such as global shares. You won't have to worry about monitoring the different shares within it. You won't need to research the individual shares. As you can select an ETF with a theme. You won't have to worry about monitoring the different shares within it. Exchange traded commodities. That's a new one. Exchange No picture for this. Exchange traded commodities are similar to ETFs, but instead of shares or indices, they have commodities as the underlying assets. Similar to exchange traded funds, but similar to exchange traded funds, but instead of shares and or indices, they have commodities as the underlying asset. It could be a single type of commodity or a diverse index of commodities around a theme. So it could be a single type of commodity or a diverse index of commodities around the theme. Like agriculture, the latter might include a number of different agricultural products in one exchange-traded commodity, like barley, corn, and milk. Okay, trading and leverage products. Once you start taking on leverage, you're venturing into the realm of trading rather than investing. So once you take on leverage, it's trading rather than investing. As you have learned, shares can be bought without leverage and may be used as a long-term investment. Using leverage on the same shares would be more about their short-term price changes instead of their long-term growth potential. Shares can be bought without leverage and may be used for long-term investments. Using leverage on shares would be more about their short-term price changes instead of their long-term growth potential. Leverage helps you get greater market exposure with a relatively small initial outlay. The increased risk comes from the potential amplified profit or losses. Many financial instruments have leverage built in and can be used on most underlying markets, such as shares, commodities, Forex, and indices. Instead of just buying an asset outright, you select a leverage position, immediately increasing the risk and the reward of the trade. Leveraged derivatives are usually used by short-term traders who hope to profit from a market moving up or down. Leveraged derivatives are usually used by short-term traders who hope to profit from a market moving up or down. CFDs, or contract for differences. Contract for differences. CFD trading is one way you can take a position on the price change of an asset. Instead of owning the asset itself, you're trading based on the price movements of that underlying asset. One way you can take a position on the price changes of an asset. Instead of owning the asset itself, you're trading based on the price movements of the underlying asset. You're trading on the underlying price movements. You're trading on the price movements of the underlying asset, underlying market, instead of owning the asset itself. One way you can take a position on the price changes of an asset. So you're trading on the price movements of the underlying market instead of owning the asset itself. They also use leverage, but they're relatively simple to understand. CFDs enable you to go long or short any asset class. CFDs enable you to go long or short on any asset class. Going long, going short. The price at which you enter a CFD position is based on the value of the underlying assets. The price at which you enter a CFD position is based on the value of the underlying asset. As it's a leverage trade, you only pay a portion of the actual cost of trading the asset to enter the market. The leverage used as extra risk as both profits and losses can be magnified. Let's see how this works. Say you want to trade a particular share which is a value at £2.45. You open a trade by buying 1,000 CFDs. The total value of your position will be £2,450, and you'll be required to pay a 10% margin or £245. That gives you a 10% leverage, which is 10 times the exposure to the market. Question: using the above example, if the share price now rises to 2.60 and you exit the trade, you have made a profit of 0.15 per share. What is your total profit and what percentage of your initial investment is it? Total profit is 0.15 times 1,000, so that's £150. What is your total? What percentage of your investment is it? So you made a profit £150 and your investment is £245. What's 150? Let me just get a calculator up. So that would be 150 divided by 245, which is your margin. So 245 times by 100, 61.2%. Yep. Because you bought exposure to 1,000 shares, your total return is your 0.15 pence. Oh no, 0.15 pounds or 15 pence profit per share, multiplied by 1,000, which equals 150 pounds. If you divide this by 150, if you divide this 150 by your initial outlay of 245 pounds and then multiply that by 100, it equals to 61.22% profit. Spread betting. Spread betting is another way you can make a prediction on the financial markets and place a bet on its price movement. You make a prediction on the financial markets and place a bet on its price movement. To use these derivatives, you'll need to pay a small deposit to open a larger position and get greater exposure. Leverage again. The cost of your trade is included in the spread, so the cost of the trade is included in your spread. In the spread. This is the difference between the buy and sell prices of an asset, which is the difference between the buy and sell price of an asset. The buy price is higher than the market price and the sell price is lower. Offer price, you deal at this price if you're buying the market, so buy at 5886. Bid price, you deal at this price if you are selling at the market, 5885. The spread is the difference between the offer price and bid price, which is 1 in this case. You don't own the underlying asset if you're trading. In this instance, you can take a position based on whether you think the market price will rise or fall. You don't own the underlying asset. You just take a position based on whether you think the market price will rise or fall. The more the market moves in the direction you've placed your bet on, the more profit you'll make. So the more the market moves in the direction that you've placed your bets on, the more profits you'll make. So the more the market moves in the opposite direction that you've placed your bet on, the more loss you'll get. The more loss you'll get. The more you'll lose. The more you'll lose. These products may have either daily, monthly or quarterly expiry dates. These products may have either daily, monthly or quarterly expiry dates. But you can close your positions before it reaches it. But you can close your position before it reaches it. If you'd like to keep the trade open for longer, that can be arranged. If you would like to keep the trade open for longer, that can be arranged with your spread better. Is that what they call them? Spread better? Let's use the same example as before to illustrate how a spread bet would differ from a CFD trade. Question. You want to take a long position on a particular share that's valued at £2.45. Instead of selecting how many shares you want to buy, you choose an amount to risk per point of movement. In this case, 1 point equals £0.01, so 1 pence. So you risk £10 per point. Huh? 1 point equals 0.01, so you risk £10 per point. Oh right, 0.01 is a change in that price. Oh okay, never mind. I was getting confused. Right. If the share price reaches 2.60, how many points did it move? It moved so 60 minus 45. It moved 15 points. 15 points. What would your total profit be if you close your position at this price? So 15 points. Each point is worth £10. 15 times 10, 150. .60 minus 2.45 will equal to 0.15, and because 1 point equals 0.01, this represents a movement of 15 points in your favour. You risk £10 per point, so if you multiply that £10 by 15 points, your profit would equal £150. Is that more or less? £150? Oh, same thing. Oh, okay. Options. These financial instruments are slightly more complex than CFDs and spread bet because of how they're structured. Options are contracts that give you the right, but not the obligation, to buy or sell an asset on or before an agreed date, strike date, at an agreed upon price, strike price. So, options are contracts which give you the right but not the obligation, so you don't have to do it, to buy or sell an asset on or before an agreed date. On or before an agreed date, at an agreed upon time. Oh, that's agreed upon price. You'll pay something called a premium to buy an option, but the trade will only be executed if you exercise your option. You'll pay a premium to buy an option, but the trade will only be executed if you exercise your option. There are two main types of options, vanilla and barrier. Okay, so there are two main types of options, vanilla and barrier. Vanilla options. Vanilla, let's start off simple. You would use call options if you think that a market will rise, while put options enable you to take a position on a falling market. Because you're not obliged to execute your trade, you can allow your option to expire if the market moves against you. Wait. You use call options if you think that the market will rise, while put options enable you to take a position on a falling market. So call options is basically going long, put options is like going short. Because you're not obliged to execute your trade, you can allow your option to expire if the market moves against you. So you would use call options if you think that the market will rise. You'd use put options if you think that the market will fall. Okay, because you're not obliged to execute your trade, you can allow your option to expire if the market moves against you. Buying call options. Buy a call option if you think the market will rise. So, you buy here. Where do you buy? Breakpoint, strike plus premium, strike price. So this is where you buy, right? Loss potential, limited to option premium. Break even point, strike plus premium. Profit potential, unlimited. Where would you buy? I'm assuming this bit is where you buy, right? Strike plus premium. Strike. Leverage is built into the option's price, but that's not the only thing you'll need to consider. Options are complex in that they have strike prices and dates. The formula for determining their value uses variables like sensitivity to volatility or the effect of changes in interest rates. Okay, I've no idea what this diagram really means actually. So, if you move against you, leverage is built into the options price, but that's not the only thing you need to consider. Options are complex in that they have strike prices and dates. Options have strike prices and dates. The formula for determining their value uses variables like sensitivity to volatility or the effects of changes in interest rates. Strike prices and dates. Strike prices, agreed upon price and agreed upon date. The formula for determining their value uses variables like sensitivity to volatility or the effects of changes in interest rates. Barrier options. These have an extra layer of complexity. You select a level at which the option comes into effect. You select a level at which the options come into effect. You select a level at which the option comes into effect. What is it? You select a level at which the option comes into effect. Your total risk essentially becomes a stop loss for your trades. Your total risk becomes a stop loss for your trade. Barrier options move 1-for-1 with the underlying assets. This means that the price of the underlying asset changes, so does the price for your option. So barrier options move 1-for-1 with the underlying asset. If the price of the underlying asset changes, so does the price of your option. If the price of the underlying asset changes, so does the price of your options. So does the price of your options. You could also so does the price of your option. You could also use a put option as a hedging strategy if you're concerned that the markets may be falling. A put option, call option, put option is going short. Rather than selling your local investments, buying a put option on an index like the FTSE 100 might help provide a layer of protection to your overall portfolio. You could also use a put option. Could also use a put option as a hedging strategy if you're concerned that the markets may be falling. If you're concerned that the markets may be falling. Rather than selling your local investments, buying a put option on an index like the FTSE 100 might help provide a layer of protection to your overall portfolio. If the market falls, your share portfolio will be worth less, but you could make a profit on the put option, reducing your overall loss. If the market falls, your share portfolio would be worth less, but you could make a profit from on the put option from the put option, which reduces your overall losses. Want to learn more? Take our complete course on options here. Fairs. Spot. Spot trading is offered on Forex, indices, ETFs, shares and commodities. It entails paying the current market price on whatever asset you're trading. You pay the current market price on whatever asset you're trading. A spot market can refer to both a physical underlying asset and a derivative instrument. A spot market can refer to both a physical underlying asset and a derivative instrument. The biggest difference is that with leveraged products, you're not taking delivery of the underlying asset, you're just trading on its price movements. If you think the index will be rising in the weeks ahead, you'll be able to buy a position on it using the spot price, with added leverage that enhances the potential risk and reward of the trade. In many ways, spot trading is a trading at its most basic form, but leverage adds an element of complexity. It has no expiry, so you can remain in a trade for as long as you want without having to worry about looming expiry. Spot trading has no expiry, so you can remain in the trade for as long as you want without having to worry about a looming expiry. Right, okay, futures. Very cool diagram here. Sure, make them 50 instead of 49.99, but spot trading, buy or sell an asset immediately at the current market price. Options get the right but not the obligation to buy or sell an asset for a set price on a set date. Futures contracts, buy or sell an asset for a set price on a future expiry date. Futures contracts are agreements between a buyer and a seller to trade an asset at a set price on an agreed upon date in the future. Futures contracts are agreements between a buyer and a seller to trade an asset at a set price on an agreed upon date in the future. Unlike with options, there is an obligation to complete the trade. There is an obligation to complete the trade. So you have to complete it, even if you make a loss. Further, your loss isn't capped, and you can lose more capital than you have in your account. Your loss isn't capped, so you can lose more capital than you have in your account. Say that you anticipated the price of the FTSE 100 may rise in the next 3 months. You take out a future contract so that on a particular date in the future you can buy the market at a lower price than you think it will be. If the underlying market moves against you instead and the price falls, the set price you agreed to pay will now mean you make a loss. Because of the obligation to complete the trade, you'll need to have enough money in your account to recover that losing position. Futures also use leverage, but the cost is built into them and subtracted from the trading price every day. Futures also use leverage, but the cost is built into them and subtracted from the trading price every day. You can trade them on several markets, including shares, indices, bonds, and commodities, futures. If you're trading on the market itself, you can take delivery of the asset. However, this only happens at expiry. You can avoid this if you sell the contracts before then. You can trade futures contracts on several markets, If you're trading on the market itself, you take delivery of the asset. If you're trading on the market itself, you'll take delivery of the asset. You'll take delivery of the asset. What does taking delivery of the asset mean? So you deliver the asset. You take delivery of the asset. However, this only happens at expiry. You take delivery of the asset. So they're going to send the asset to you. Nah, that's not what it means, right? However, this only happens at expiry. You can avoid this by selling the contract before then. You can also trade CFDs or spread bets to trade future contracts, meaning you'll never physically own the underlying asset. You can also trade CFDs or spread bets to trade futures contracts. You can also trade CFDs or spread bets to trade futures contract, meaning you never physically own the underlying assets. You can also trade CFDs or spread bets to trade futures contract. So you'll never own the never physically own the underlying assets. You can also trade CFDs or spread bets to trade futures contract, so you never physically own the underlying asset. I'm going to leave this episode here. So we've still got some other investment products to do, which we'll finish off in the next video. So yeah, thank you all for watching, and I will see you all in the next video. Bye bye.